Dwayne, Denver, Colorado, the high city.
Mile
Hi.
High?
Yeah,
And he
thank
starts
you.
it with high.
Hi. Hello, Dwayne. I'm 53 years old, looking to retire at age 60, married, wife 50. We currently have $1.5 million in retirement accounts. I envision needing $100,000 a year. My question is, given those broad parameters, what would be a current or appropriate amount of bonds and stock allocation both now and the next 5 years? Also, we have only remaining home debt of about $135,000, which will be paid in full in 7 years. Thanks. All right. So Dwayne's 53.
Great question.
Looking to retire at age 60. He's got $1.5 million. He wants $100,000 from that account. What should be his stock bond allocation?
That's a great question. So I'm just kind of sort of paraphrase. So it looks like, Dwayne, you're planning on having your mortgage paid off, I guess, by the time you retire, which is fantastic. So, and I don't know, you're
Pretty good with math.
Yeah, I'm right with it today. So, he says, I envision needing $100,000. I'll assume that's over and above, or that's not including the mortgage, because the mortgage will be paid off. I'm going to make that assumption right now. What I don't know, Dwayne, is how much you're saving currently. So you got $1.5 million, and so the $1.5 million.
Let me see your calculator real quick.
Yeah, you calculate while I'm talking. But $1.5 million, and if let's just say you're maxing a 401k, $24,500, and maybe Joe put in 6 or 7%, something like that. What does that come out to be?
So if he's got 1.5 and he's got 7 years,
yeah.
Let's say he gets 6% on the money, and he's saving $24,500.
Yeah.
All righty.
Yeah, let's go with that.
And then, so that's $2.4 million.
$2.4 million. Okay.
Look at that, Dwayne. We just got you $2.4 million. All you got to do is max out your 401k and get 6% over the next 7 years.
Yeah, and we sort of want your
and
distribution.
You take 4% on that. That's $98,000.
Yeah, we'll call it 100. We'll round it.
Boom.
Yeah, and then there you go.
What stock bond allocation does he need? Well, I think you can play conservative now, because let's say if he targets a 6% rate of return, then he's home free. Now, if he has pensions and Social Security, that's going to be gravy on top of that. But he's 60 years old when he retires, so he's got to bridge that gap.
Sure.
Right. So he's got to look from 60 to 67 potentially to get Social Security, or if he's going to push it out to to 70.
So based upon our assumptions, I would probably do a 60-40, 60% stocks, 40% bonds.
Yeah, I think that's right in line. I think anywhere between 40% stocks and 60% stocks.
I agree. You probably don't need more than that in terms of stocks. And if you want to play it safer, go 50-50. And I'm not even opposed to 40% stocks, 60% bonds. But I agree, somewhere in that range based upon what we know about your situation.
Right, because he doesn't have to shoot for the moon here.
Right.
He's already done a really good job. He's 53 years old. Wife's 50. They got $1.5 million saved.
And that's not even including Social Security or pension. So a lot of this, as you say, Joe, might be gravy.
Right. And so I think, Dwayne, congratulations. I would not say, all right, well, 100% stock portfolio or 100% bond portfolio. I think you still need risk in the portfolio to get a target rate of return. You need 6%.
Yeah, and something else you might think about is if you want to go 60% stocks now as you get right to retirement, you might dial it back a little bit, maybe 50-50. Maybe 40% stocks, 60, but you still need stocks, because chances are one of you is going to live into your 90s. So that's 30 years. Right. So and that's where people make mistakes, Joe, is they think, okay, I retire, so I can't take risk anymore because I can't make the money back. Well, yeah, you definitely want to make sure you have a portfolio that you can draw upon in bad markets. But the fact of the matter is, you may live for another 3 decades or more, and that's your time horizon. It's not like 1 year. It's 30 years or more.
Right. And with the amount of information that we have, I think that's the best way to go. Our advice could completely change if, Dwayne, you have a pension at age 60 that's paying you $80,000 a year, and you want $100,000. So now you only need $20,000 from the overall portfolio. Then it gets into a little bit different type of discussion.
Well, it does. And so now I think we'd have a lot more latitude. So you don't need to take a lot of risk. So if you want to be conservative, 10, 20% equities, then fine. On the other hand, because you don't necessarily need this money, what's it for? Is it for the kids? Is it for charity? Maybe you take a little bit more risk because you can afford to.
Right. And then, or maybe you look at it and you say, you know what? I don't know. Maybe 100. That's the baseline.
Yeah, maybe
some years it's going to be 150 because we want to
Yeah.
go on a cruise or we want to do this. And I don't know. Listen to Susie Orman. You probably need 30 million because you're going to
Yeah,
have a
don't need 50.
catastrophic event that,
Right.
of course, is going to happen to you. And you're
So,
going
so I guess the point is there's a lot of variables, and we don't really know your situation fully. But just based upon what we know, probably the 40 to 60% equities would probably be a good place to be.
Now, Dwayne. Now let's take this to the next level here, Alan.
Wow. Okay, we're going deep.
Yeah, because he still has 7 years. He's 53 years old. He's got $1.5 million in retirement accounts. He never specified, all right, what type of retirement accounts are these? Is it all IRAs? Is it all 401ks? Is there any Roth in here? Or does he have a brokerage account that he's labeling for retirement? Or is everything in a retirement account? So if he continues to save the 24/5 in the retirement accounts, it gets 6% over the next 7 years. We just did the calculation, approximately, roughly, it's no guarantees, blah, 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 of about $2.4 million.
Right.
Well, if that's all in a retirement account, that's all going to be taxable income. If you want to spend $100,000 a year, all right, well, then now, hey, you're going to be in a little bit higher tax bracket if you want versus if you wanted to spend, let's say, $60,000 a year. And then you're going to have Social Security on top of that. And if you have any other pensions, all of that kind of layers on top of each other where that could pop him up into even a higher tax bracket than he is now. So that's where diversification of taxes come in. You have 7 years. So if 24/5 is that savings number, all right, how much of that is he going to be putting into retirement accounts? How much should he be putting into Roth? Does a Roth conversion make sense? Can he broaden that 1.5 million out to get a little bit more diversification tax-wise? Because if that's the case, well, then he doesn't necessarily have to accumulate that much because a lot of it is going to him, not to taxes.
Yeah, and that's a really good point because right now that the 24% tax bracket goes up to $315,000 taxable income for a married couple. If you had that kind of income last year, 2017, you were probably subject to alternative minimum tax and you probably were in a 35% effective rate. So this is 11% lower tax for many. And so and then you think about, well, you know, at this tax law, at least at the moment, it's going to sunset. So 2026, we go back to the old rates where you might be in the 25 or 28% bracket or worse. So it's like, I totally agree with that. It's like, make sure you've got tax diversification in addition to the savings plan.
Right. So he needs a savings plan. How much is he going to save? Where is he going to save it, right, from a tax perspective? And then from there, what does that allocation look like? I think he's skipping a beat here by saying, well, show me the allocation first. Well, no, let's look at, all right, well, what's your fixed income sources? What's your income going to look like in 7 years? Where's that money held right now? And then now break it out a little bit more from a tax perspective. And then from there, that's when you can start really dialing in your overall allocation. So Big D from
It's a great question.
Denver. Dwayne from Denver. Colorado.
Mile High City.
Mile High.
Yep. You
All
been
right.
there?
No.
Yeah.
I have not.
I've been there many, many times.
I know you
it's
have.
It's a great
You're
place.
a big fan.
Yeah.
Buffs.
Yeah, Buffs, Rockies, whatever.